Joining me now, we've got Matt Stucky, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. Good to have you back here with us, Matt. The past few weeks, we've seen a lot of volatility. You have 3 tips for investors to navigate this market turmoil. Lay them out for us.
Yeah, thanks for having me, Brad. Yeah, so 3 things I would really lean into if you're an individual investor here is first, focus on diversification. Just looking at the levels of volatility across the investment landscape today, we're at near 5-year highs in terms of equity volatility, currency volatility, as well as fixed income volatility. Those things can be very difficult to manage unless you're well diversified. And so I think lean into diversification in terms of equity exposure, both in and outside of the United States, real assets, as well as high quality fixed income. When you fit all those together, you're able to better navigate really volatile environments like we're in today. Secondly, I think in terms of another tool to use is time horizon. The markets are digesting a lot of policy uncertainty today, and that's not necessarily resolved in the next month or the next quarter, or even the next year. And so, an appropriate time horizon for us, we think that's more in the 3 to 5 year is more likely to capture a lot of successful outcomes if we have an appropriate time horizon. So that's the second point. And then lastly, one of the interesting tips that you can do as an individual investor is in a calmer situation, outside of trading hours, think through some of the best companies you can think of, and think through some of, in terms of valuation, a ridiculously cheap price that you'd be willing to pay for that company, and put that in as a buy limit order. And if you happen to get it, if you happen to get a fill on that order, you really kind of feel like you're taking advantage of the volatility in terms of getting a dislocated asset at an attractive price. And so those are 3 things to just keep in mind as we're kind of navigating really choppy markets here.
Matt, we often hear this phrase, buy the dip, but how can investors determine which dip is viable, what dip to buy, and how to go across kind of their own checklist as they're looking at a lot of dips right now?
Yeah, I think that's a really tough question to answer. I think buying the dip, is always easy to do if we're looking in the past. It's harder to do when we're in the present. And so looking at today's environments, who knows whether or not the levels we are today are indeed the levels that, when we look back a few years from now, we're the bottom of the market. And so, if I were in your shoes, or one of the shoes of your viewers, I wouldn't necessarily hold myself to nailing the bottom. I would just look across the investment landscape and say, these are good values today at these prices. I'm willing to step in and have the appropriate time horizon to have a successful outcome 3, 4, 5 years down the road. And so, I would say, continue to stay diversified in this environment, and put capital to work in a diversified way. That's your best bet for navigating volatility in this environment.
What's your top equity or stock idea for us right now?
In terms of individual names, put aside the comments of the diversification, companies that to me have higher quality characteristics make a lot of sense in this environment. They tend to have pricing power to offset a lot of the trade back and forth that we're seeing in the headlines today. They tend to have kind of more stable end markets, and from a balance sheet perspective, they tend to be also better equipped to handle ebbs and flows in the economy. And so a name like Intercontinental Exchange makes a lot of sense to me in this environment. Just looking over the last 12 months, volatility actually is a boost to their fundamentals in their exchange business. We've seen volumes in the futures business up roughly 30% year over year. And then if, let's say that policy uncertainty translates into macroeconomic downside, to me that means interest rates are likely moving lower, with the Fed coming back into easy mode. That's a tailwind to ICE's mortgage business in terms of mortgage activity, coming off of roughly 20-year lows back to growth territory. And so that's a name that I think is uniquely positioned, given its high quality characteristics and a little bit of defensiveness in the business model that can operate well in this environment. And
what about the bond market? How should investors be playing that right now?
Fixed income to me is attractive here. And when I say that, that's a big market. Specifically, I'm talking about high quality fixed income. And take the 10-year Treasury as an example. There's been a move higher in the last few days, in my opinion, driven by a lot of deleveraging, as well as sticky inflation expectations and the lack of probably Fed stepping in, at least right now. But think about the risk reward from here. The 10-year Treasury is at 4.35. Shock interest rates up or down 100 basis points and put a 1-year time horizon around that, what's the outcome? If rates were to move higher by 100 basis points, your investment would be down roughly 2.5% or so. That's not a terrible outcome. Obviously, it's not ideal, but take the other side. What if rates rally? What if rates go down 100 basis points? What's the outcome? It's about a positive 11.6% total return. To me, that return skew in terms of what could go well versus what could go wrong leads me to say that this is an attractive investment and it's well diversified against potential downside on the horizon for equities.
Matt, good to see you. Good to have you back on and continue the conversation. Look forward to checking in the future.